Hello, my name is Risley Sams, founder and president of RHS Financial. Welcome to the May 2014 newsletter video. We're here today. We're going to deviate a little bit from the normal format and talk with Colby Davis, an analyst here at RHS Financial, who's recently written a nice white paper on it's called A Guide to Rational Investing, and I think it's very interesting. You can download it at rhsfinancial.com. But to talk a little bit about our newsletter, the May 2014 newsletter focuses on its title, and that title is Dow Ekes Out Its First 2014 Record. What does that mean if you infer from that? One, eking out means, well, we've had a lot of volatility going forward up to this point, but it does speculate that it is its first record of 2014, meaning most pundits think the market will go higher this year. We can only see and we can only infer from that. Now, speaking of which, when it comes to investing in a volatile time, there is a rational way to do that, and Colby again has written a paper on it, and so I want to ask him a few questions about his paper. First off, Colby, you mentioned in your paper that the stock market has been a great place to earn returns for investors. Tell me a little bit about that.
Right. So when most people think of the stock market, they focus on more recent trends or the latest headlines. But when you look at the broad sweep of history, the overarching trend is pretty clear. That it's a great way to build wealth over time. The average annual return on the S&P 500, going back to 1926 when it first started, is about 9.8%. For after inflation return of 6.5% to 7%. And financial historians have looked back even farther than that into the early 1800s in the US and UK markets and find similar returns. So, over the broad sweep of centuries, we see these pretty significant returns. And in looking at international markets as well, in any country that has a stock market that's been around for several decades, we see the returns there much higher than local government bond or cash markets.
So you also mention in your article that investors can be their own worst enemy. Tell me a little bit about that.
Right. So despite the long-term significantly high returns we see in the stock markets most everywhere and every time, most investors don't realize these returns. In fact, in the 20-year period ending 2012, JP Morgan Asset Management found that while the returns on the S&P 500 were in the neighborhood of 8%, the average investor had a return that was actually lower than inflation. It was something like 2%. So in real terms, the average investor is losing money when they invest. And they do this because we find that they are typically afflicted with these predictable cognitive biases that cause them to make these routine mistakes, such as focusing on headlines and buying stocks of companies that have only recently done well or are in the news, or they concentrate their portfolio on what's comfortable to them, such as their employer's stock or the stock of their local utility company.
Mm-hmm. So how could hiring a financial advisor like our firm or another firm help with this?
So in order to reap the benefits of rational investing, you need a systematic process that looks at the entire market and analyzes it in a statistically rigorous fashion based on the principles of modern portfolio theory. Most people have neither the time nor the inclination to do this and to monitor their portfolio regularly and rebalance as necessary. A good financial advisor will have an entire practice over which to leverage their expertise and software services and so forth to precisely monitor portfolios and rebalance as necessary, earning the best possible return for the risk taken.
So to sum it up, you would basically say that the stock market is a good place to grow wealth. Individual investors who are, try to juggle managing their own time and all the different things that are going on in their portfolio tend not to do well because they focus on recent biases and are concerned about losses and don't know when to get in or try to time the market rather than stay in the market. And finally, they don't use an investment advisor can help them by leveraging all the information over their whole practice and what they're doing in a systematic way in order to make sure that they maximize their returns over time.
Right. Dedication and focus on the long term are the key ingredients, and a financial advisor can help with setting a framework for success for exactly that.
Excellent. Well, there you have it. Thank you very much for tuning in this month, and we'll see you again next month.